Let me talk to Moody's Investor Service. Big story, a new report today on the global banking industry, painting a negative outlook on the back of the expected tighter monetary policies by central banks around the world. The Moody's report also focused on key trends in Africa that could impact banks on the continent. Let's drill down on this now with Kelvin Emmanuel. He's an economist and a board member at Obsidian, Achana, Nigeria. Kelvin joins us from our Abuja studios tonight. Good evening to you and welcome to the show, my friend.
Thank you so much for having me. Good evening to you.
Thank you. We appreciate that. Do you agree with Moody's outlook that the era of central bank tightening is not over yet and that rates loosening will have its own implications for banks around the world?
I'm not surprised by the report. And the reason I'm not surprised by the report is because Moody's said that the era of monetary policy tightening around the world, which has seen consecutive interest rate increase, the FOMC has been on an interest rate increase binge in the US, and that has seen the federal funds rate go up, and has seen the inflation level in America come down from nearly 8% down to a little below 4%, if I'm not mistaken, inflation figures. You can also see in the European Union. And I'm not surprised that Moody said that they expect that the fact that the quality of loans are going to reduce because you're going to have higher non-performing loan ratios, and you're going to have higher loan loss provisioning ratios based on IFRS 9 standards that is used for auditing banks around the world. These are realities that you see in Africa, especially in West Africa and Sub-Saharan Africa, and particularly with Nigeria. And Moody's also said that the foreign exchange shortage in countries like Kenya, in Tunisia, in Egypt that has had issues with the Egyptian pounds and has relied on IMF support and intra-central bank lending from members of the Middle East and North Africa Gulf Cooperation Council, and especially in the West African Monetary Union with Nigeria as an example, one particular point that interested me in that latest report by Moody's, is the fact that the downgrading of sovereign credit rating of countries like Nigeria that has seen its credit rating downgraded to CAA1 also has an impact on the banking system, because the banks in these countries, they do business in Naira and they're exposed to the sovereign credit rating of the countries that they're attached to. So the higher the country risk premium goes up for Nigeria, the higher the equity risk premium goes up for the banks, and it affects their ability to raise capital, especially from the international debt capital markets.
You are in the securities markets as well, Kelvin. So if the Moody's report says profitability from the past 2 years are likely to subside in the banking sector because you have lower loan growth, you have loan loss provisioning needs, funding liquidity more challenging on tight policy. Does this speak to what you think should happen ahead with banks making so much money despite the fact that there's an interest rate tightening around the world, there's inflation up, dead or alive, the banks make money?
Well, the important trends that Moody's highlighted that will impact frontier Africa markets in Africa is the ability to raise sovereign Eurobonds, especially in countries like Kenya and Ghana. Moody's talked about Ghana, the fact that the local debt restructuring is completed, but the international debt restructuring is still pending because the government hasn't come to terms with foreign creditors. And Moody's talked about the fact that because these countries in Sub-Saharan Africa don't have reserves, FX reserves, they're going to find it difficult to cope with restructuring their external debt. For example, Nigeria has like $1.2 billion of Euro bonds to pay in 2024. And some of these countries have higher payments to make. And the fact that they have shortage in foreign exchange will make the refinancing cost higher than it is usually supposed to be. And Moody's also highlighted the fact that, for example, the capital adequacy ratio that in the US, in the European Union, the aggregate capital adequacy ratio, when you had the common equity tier 1 and the additional equity tier 1, is somewhere around 19.6%. In the US, it's dropped to 14.95%. Moody's talked about the fact that there's most likely going to be an increase in capital adequacy for banks in America. In Asia, it's 15%. It's stable. But in Africa, in Nigeria, for example, there might need to be like recapitalization that will require more banks to bring in more additional equity, to balance their minimum capital ratio because of the devaluation of currency. And especially for Nigeria, what my fear for Nigeria, especially for the Central Bank of Nigeria, is the fact that the Central Bank of Nigeria has huge revaluation losses that I estimate at anywhere around 30.5 trillion naira that it has to pay from FX forwards. And the banks have booked it as revaluation gains on their balance sheet. And what I suspect the CBN wants to do with the circular I sent a few months ago is swap that revaluation losses in exchange for minimum capital increase from Nigerian banks, and then add whatever difference is remaining depending on how much the CBN requires the banks to raise their minimum capital to for Tier 1 and Tier 2 banks. So my concern is with the removal of the limit of 2 billion naira that for standing deposit facility, which is the rate at which banks keep money at the Central Bank of Nigeria. A lot of banks, because of the high interest rates and the fear of companies not being able to pay back loans and the increase in non-performing loan ratio, more banks will pack up their money in the central bank at risk-free rates that are anywhere around 16 to 17% per annum. So these are my concerns, but I think when you look at that report, the major concern is the foreign exchange shortage. And considering the fact that in my estimates, I think the CBN has net reserves and net negative reserves, how it's going to manage its balance of payments going forward. Look, Nigeria spends about $85 million per day on everything from PMS to AGO to Jet A1 to asphalt to petroleum coke to base oil that is used to make lubricants to LPG imports on a daily basis. So my estimate is that Nigeria spends about $2.4 billion per month on about 9 different items that are imported for energy. So the question is, how do you get FX to meet up with the balance of payments for all of this demand? How do you do backward integration to reduce how much of those imports you make? How does the official authorities coordinate to ensure that they increase their revenue and also, tighten their belt and reduce spending to ensure that in the future the government does not have to rely on central bank overdrafts that will devalue the currency because you don't have assets and reserves to back up any quantitative easing you do, and then expose your supply chain when your currency drops or weakens, that fuels inflation and fuels the central bank increasing the interest rates, and then in turn it causes a situation where as interest rates go up, asset quality reduce, loan quality reduces because non-performing loan ratios go up, and banks have to do loan loss provisioning, and it's a whole cycle all over. So these are my concerns for the banking system in Nigeria, and the report that Moody's gave on the outlook is very, 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 very much spot on.
Very much spot on. Thank you so much for making the show tonight. Thank you, Kelvin, Emmanuel. We appreciate your insight as well. Do have a pleasant evening. We appreciate that from our board.